Awesome, so here's our last stock of the series. One that I'm really excited about, one that I wish like all my investments would do. Like if you could just have every investment you have go like this trade, like you would be retired. It would be so easy. Basically what happened is this is Regal Cinemas, and they went public in 2003. You might notice this chart only goes to like 2018, which is like, what the heck, that's a long time ago. And the reason why is very, 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 very simple. They got bought out by this gigantic European cinema company called like Cineworld for $3.6 billion. And to give you sort of some perspective on that, we talked about AMC last module. AMC is about $750 million company. So you can kind of see Regal here getting bought out. Obviously they were worth more, but when you have a buyout of an entire company, usually what happens, and this pretty much happens almost every single time that there's a buyout, you have like the stock price, right? And then the stock will trade sort of in a normal range, whatever the trading range is. And for somebody to buy the company out, like with a full takeover bid, if they were gonna like buy all the shares at the market, they would suck up all the supply of sellable shares, and everybody would be forced to sell at higher prices, because if you have somebody that wants to buy 100% of the available shares, it's gonna create an infinite amount of demand. And you know, people can sell for $1 bajillion, and if you want to buy every single share, you're gonna have to pay them $1 bajillion. And so when there are buyouts of big companies by other big companies, basically what they do is they say, look, we're gonna put in a takeover bid, we're gonna pay a little bit of a premium over the current price to everybody so that we get to buy all of the shares. And basically, as a normal investor, you can't really do anything about this. But it's a really good thing as long as you're long in the position and you're not short, because basically what it means is the stock instantly goes to the buyout price before it's even secured. And then assuming the deal gets secured, it might go a little bit below the buyout price, but as soon as the deal is secured, it goes right to the buyout price, and then your shares get bought for whatever the buyout price is, which is usually a pretty solid 10-15% premium. And it was kind of exactly what happened here with Regal. So basically, I bought at 15.7, which is right here, and then within like a couple of months, I think it was like a month and a half, they got bought out at $23. So I guess that's like 3 plus 4 is 5. So that's like about a 30% gain, and that really, like, you can't predict that. Like, that's just like, you know, you have a portfolio. It's got a bunch of stocks in it, and by dumb luck, one of them gets bought out at a 30% premium, and you make 30%. Like, there's not much logic to this. It's just like, this is why you want to diversify. Like, if I wanted to invest in movie stocks, right, and I put all my money in AMC and none of it in Regal, first of all, I would have done really badly because I didn't set a stop loss on AMC. But second of all, like, if I did set a stop loss on AMC, you know, I would have been out of that position, lost like break even, give or take, maybe a couple of percentage points. But now that I have Regal as well in my portfolio, that's a net average gain of 15%. Now, between you and me, I have no clue if Cineworld is going to buy Regal or if Cineworld is going to buy AMC. Like, for me, like, I don't freaking know. I don't know that much about the movie industry. So, you know, you kind of have to like get in both, and then one of them works out, and if you don't really know which one it's going to be, then, you know, you just take the money and you run. And that was basically the strategy. It was diversification here, where you're diversifying half in AMC and half in Regal, and it worked out. It worked out really well. They got bought up, and I don't know what made them crash so hard, but I mean, it was kind of like an M setup, and then it wasn't really an M setup, but it was kind of an M setup, and then they crashed. But then they got bought out, so like the price went up a whole bunch really quickly. This is definitely more of a conservative M setup, like we were talking about earlier. This would be more like, you know, the height of the M, and then the height of the M subtracted from this line right here. So you can short this. I didn't short this, but you could definitely short this on an M setup with a 1 deviation downturn. You gotta be careful, because if you don't set a stop loss once it gets here, like I would set a stop loss at 16 once it gets to 15, and then you would make about 20% on that short, or probably about 3 or 4x on the options. Yeah, so that's one thing you could have done. Another thing you could have seen is that in 2008, when they crashed really hard, they had this huge red volume candle, huge red bar with a massive, massive wick. And I feel like I'm beating a dead horse when I say this. You know, buy stocks during recessions and you will make a lot of money, is basically what you can learn here. You can buy this for like 10 bucks, and then within the next year it was worth 15. So if stocks are on sale, scoop that stuff up, because as long as you're investing in quality companies that get bought out for $4 billion, you're gonna make a lot of money. So yeah, pretty simple trade here. It was really just kind of a diversification. Like I said, my mom kind of was like, hey, you should buy movie stocks. And I'm like, okay, thank you for your outside perspective. And then that manifested itself into, a couple grand, which is pretty nice. So that said, there's not much else to this position. The only other thing I could see here is if you look at this sort of as a wedge, symmetrical wedge, and if you did, then you could have bought it in 2013, and within a couple of months, you could have gone from about 14, 15 bucks, I'd say $16 entry point, to about 22 bucks. So basically the exact same 30% gain based off of this symmetrical wedge setup. And also, I guess they kind of broke below this resistance level, the support level, and as soon as they broke below that and started crashing, obviously, I don't know if it warrants being said, but if there's a recession, you should short a bunch of stocks if they have good short setups, and you'll make a bunch of money. So it's pretty foundational, but it's also stuff that I know a lot of people need review on. So here it is. If the market's going crazy high, buy this wedge setups or buy the symmetrical wedge setups. Stop loss on this trade is honestly probably about right here. This candle right here scares me a lot. Like that probably stopped out a lot of people. That's a very dangerous candle because it reverses all the way back to this middle line, which is why sometimes this middle line can be a bad stop loss level, especially on a monthly trade. I wasn't in this trade. I was like 12 when this happened, so like I wasn't in this trade, but it's definitely a nice symmetrical wedge that had a lot of growth behind it that worked out really well. And an M, I didn't even see this M when I got into the position because I didn't know about it, but that is a really nice M. I don't know like what software this is. I don't know if I can add Bollinger Bands, but if I can add Bollinger Bands, then I'll add them. Okay, I can sort of, I hope you guys, I don't know what software this is, but you kind of see it bounces off the top, bounces into the Bollinger Bands off the top, and then back into the Bollinger Bands, then you could short it like right here, and you could make about $3, $4. So give or take like 15%. And then again, the wedge. So really cool, just some technical plays here. Technical plays though that are played out on a monthly basis. So these would be more like those positions you would check like once a month. And then that would be about it. I mean, there's not much work to do here. These are pretty slow-moving stock. This, at least, is a pretty slow-moving stock until, of course, they get bought out by dumb luck and go up 33%, which is nuts. And that's why, like, you just have to start investing. Like, if I had delayed in starting this portfolio, this was obviously not my portfolio, but my first portfolio. Well, I guess, I mean, it was sort of like my first, like, overarching long-term portfolio, but I've been trading for a pretty long time. But anyway. Like if I waited like an extra month, or if I waited like 2 months to start investing, like I would have totally missed out on this entire gain. I would not have had any of this growth. I would have not had any of the gains or any of the money that came from this trade. Because if I waited 2 months, then the stock would have been bought out, the company would be done at 23 bucks, and I would have missed out on all the growth. And so like I can't stress this enough. The most important thing you can do is to just start investing. And the best time to start investing is right now, because you don't know when you're gonna have a setup like this, where you could wait 1 week and miss everything, or you could invest today and make, most people make 30% in like 3 years. And so if you can make that now, then like I just can't stress enough the insane importance of just like getting in the financial market. Because this is the kind of stuff that you can't just like give someone. This is the kind of stuff that you have to go through. And this is the process that you want to work through, where you get that first investment and it makes a move. Sometimes it's down, sometimes it's up. And you just work through it and you learn from it. And I mean, it's changed my life, it's changed the lives of so many students. And I hope it changes your life too, because honestly, financial markets are like literally the gateway to long-term quality assets to really build real savings and retirements on sort of an institutional level and also on a personal level. So that's kind of the big takeaway here. So with that said, get out of here, go buy some stocks, or short some stocks. It depends on when you're watching this, I guess. I don't know if I would have started out, like, I never really started out shorting, just because you have to like know how to do that, and it's like, you push the sell button, but you're like, well, what if you don't have the stock? And then all you really have to do is just sign up for a margin account with whatever broker you use, and you should be able to just short naked stock. You just have to pay like usually a little bit of fees. I know I've got a pretty solid position right now in Coke bottling, and I think you pay like just a dividend and like a small fee. and it's been working out pretty insanely freaking well. So that's kind of one example. Like, but when you're starting out, like, just like find stocks that are like super cheap, and then buy them, assuming that they have a lot of inherent value. Because obviously it's not just price. Like, price isn't the only thing that matters. For me, when I got into this company, again, like this stock isn't like a publicly listed stock anymore. The company that bought it's private, so I can't pull up on Yahoo Finance. But when you buy it, you want to know, like, do they make money? If they make money and they have a really nice technical setup, which you guys have that at 9 to noon, then you just get in the investment and let it go. And, hopefully you absolutely crush it, which is really the big payoff and really the goal and really why I do all this stuff, is that you can have that success and you can really knock it out of the water, knock it out of the park. So with that said, thank you so much. I really appreciate it, and hope you've enjoyed the Portfolio Secrets Masterclass. So with that said, guys, go out there and freaking trade some stocks and invest. Cool. Thank you very much. Bye.